Hi, Andrew here. In my experience, a lot of people are intimidated by investing or it's very nervous. So they've had poor experiences before, or they just find the world of investing and stock markets too complicated, too full of jargon. And whenever they hear about stock markets, it tends to be on the news or in newspapers when they hear about big losses wiping the billions off pension funds. So naturally, we become more nervous and less inclined to want to take investment risk with our money. And if we do so, at a lower level of risk, so we don't experience those scary investment markets. So what I want to take you through with this presentation is provide you a bit of context around investment returns, investment risk, and time, so that when you make any investment decisions, you decide to invest, whether it's your pensions or your ISAs or surplus savings that you have, you're doing so with a broader understanding about investment returns. And hopefully that will give you more confidence and help you sleep at night, particularly when markets are doing scary things. So, what I'm going to take you through here is investment data. It goes back to 1956, so 68 years of worth of data. The information provided comes from an investment company I use called EBI Portfolios Limited. Most of it is simulated data because the portfolios have only been around since about 2019, but it is still sufficient to give you an understanding of that relationship between investment risk, reward, and time. Now, there's quite a lot on this table, so I'm going to take you through it by bit. And if something isn't clear, by all means, stop the video, skip back, and play it again. Of course, you always can ask me questions, get in contact and ask me questions. So, start with the basic outline. What we're looking at here, as I said, investment returns since 1956. We're assuming here a portfolio of invested around £300,000. So a typical, an average investment. Yours might be slightly smaller, it might be slightly lower, but it'll give you a broad understanding. This first column looks at different portfolios taking different levels of risk. So at the very lowest level of risk, we've got a 100% bond investment. So this is investing in global government bonds and high quality corporate bonds. And that's when we as investors lend money to the likes of the British government or large corporates. And in return, we expect to get our money back in payments on that money we've lent. And every increment of 10 on the table is a 10% increase in exposure to global markets. So into shares or equities, as otherwise known. So the 10 would be 10% in global stock markets, 90% in government bonds, all the way up to 100% in global stock markets, nothing in government bonds. So if we look at the next column, that's looking at the compound annual return, so the average return over that 68-year period for the different portfolios. And so, as we might reasonably expect, the more we invest in stock markets, the higher the return. So if we'd invested 100% in global stock markets from February 1956, we'd have got an average return of 12.2%. Whereas if we took a much lower level of risk, we'd have got slightly over half that return. Around the middle of the road, we're looking at double digit 10% per annum returns. So they'd say pretty attractive. We'd be happy with those. But we've got to remember inflation will have a negative effect on those returns. So when we allow for inflation, which has averaged 5.3% over that 68-year period, which includes the recent period of double-digit inflation and also the period in the mid-70s when high inflation was high for similar reasons, Middle Eastern crisis, oil prices spiking, pushed prices and interest rates up around the world. So when we allow for inflation and look at what's called in today's prices, you can see the returns of the high risk investor would be over half and much lower, still positive returns in real terms, but much lower inflation for the lower risk bond investor. And around 5% if you're taking a 60% market allocation and a 40% global government bond allocation. And what we also need to remember is that the truism of investing is if you want to get higher returns, you have to accept higher risk. And risk in the stock market or investing context is volatility. The technical term for volatility is standard deviation, and that really just means how much returns go up and down. So the bigger the standard deviation number, greater the volatility, the more returns go up and down. So you can see for someone who would have enjoyed a 12% annual return on their investment, standard deviation would have been near 15%. So if that feels too much for anyone, take less risk, very cautious level, looking at standard deviation of 3, still some risk with investing, as we'll see in a minute, but you can't accept, if you can't accept higher risk, then you accept lower returns. So now what I want to look at is different periods of time, see what these different levels of risk would have had on returns over that 68-year period at these different levels of risk. So the first period of time is looking at over 1 year. And what I'm looking at here is the lowest returns in that period of time. So we're looking at the lowest single year returns, looking at 1956 to 57, 57 to 58, and so on, the different levels of risk. And we can see that at the very cautious end, as I said, even cautious investors can lose money. This green colour denotes the current period we've been going through. So the start of the Ukraine war and the effect that that's had on inflation, energy prices, food prices, prices generally, and the rising interest rates. And we've also got to thank Liz Truss and Kwasi Kwarteng with their mini budget and the catastrophic effect that that had on government bonds, which meant for cautious investors, they had lost around 11% of their money in a single year. Now that's extraordinary for that to happen. We still have to be aware that even cautious investors can lose money. But at the top end of the scale, someone investing 100% in a global equity portfolio, they had a period of time where they lost over a third of their money. So their 300,000 would have fallen to just under 200,000. That period was that 1973-74 period I referenced earlier, when we had that Middle East crisis, the oil crisis, and high inflation. In fact, that was a very difficult period of time for investors of different risk levels. Even at a 50/50 portfolio, middle of the road, you're looking at 12% loss. So now if we expand a period of time and look at worst 2-year periods, so 56 to 58, 57 to 59, and so on, we can see the losses still can be pretty scary. In fact, for the higher risk investor, they're looking at a near 40% fall in the value of their investment. So 300,000 down to just under 186,000. And for cautious investors, still looking at the current period, looking at an 11% loss. Now, importantly, what we're looking at here is not a 39% or 11% or any of these numbers in the first year, and then again the second year. It's over that 2-year period that have lost. And when we expand the period to 3 years and lower 3-year returns, you can see cautious investors are starting to get a bit of a recovery. But even so, you've still got periods of 3 years where everyone at risk level, at any risk level, has lost money. This purple period here, purple patch, denotes the period of time when we went from the tech bubble bursting in 99, 2000 into 9/11 and then the second Iraq war, which was a very difficult period for stock markets and investors suffering again, over a third of their portfolios falling in value, but it's getting better for cautious investors. And now when we look at 4-year returns, we're starting to see periods where there hasn't been a negative return in time. And this really underlines a point that when you're investing money, you need to think really at least 5 years onwards as a period of time you can afford to invest the money without wanting to access it. Because even at the higher risk levels, we're still looking at double-digit returns. We're getting recoveries, people are still seeing losses. And again, at 5 years and 7 years, you can still see at a 90% level, markets 10% cover. We've got a net return, a zero return. So it's got the recovery, but higher risk, looking at -7. But when we go out as far as 10 years, you can see there hasn't been a 10-year period at any level of risk where investors have lost money. The lowest return for a high risk investor has been 36%. And that was from the period of the credit crunch and the tech wreck. So that's 99, 2000 through to 2009, 2009, 10. So we're getting some difficult times, but we've got the recoveries because we invested for long enough. And over 12 years, you can see it improves. Now, the observant amongst you, and a lot of people say at this point, well, hold on, Andrew, why would I go through all this pain here, high levels of risk, if at a 50-50 portfolio, the lowest return is actually higher, it's 86%, where here I'm only getting 63%. That's where I remind you that we're looking at the lowest returns here. When we flip it, and look at the highest returns, you can see the numbers are much more in favor of high risk investors. So this isn't color coded, but what we know is when markets fall and then recover, highest returns usually are immediately following the losses. Because markets, when they recover quickly. So you can see a high risk investor, their highest single year return has been 81%, which I think is probably 1975. So immediately following the 73, 74 crash, when people start to think, it's not so bad. We want to get back into the stock markets, and it had that swift recovery. Even cautious investors had a very positive 28% return in a single year. When we look over the long term, investing we do so for the long term, you can see the returns you get relative to the lower risk portfolios, the more investment risk you're willing to take. So when you're investing money and the decisions we'll make together to say, well, at what level of risk are you comfortable? Could you tolerate some of these losses and the potential of high returns? Or would you not sleep at night at this sort of level, so you're willing to give up some of the higher returns? Willing to give up some of the higher returns just so the scary times aren't quite as scary for you. Now, the other important thing to point out and to take you back to your school days and your math lesson, we're looking here at the lowest and highest returns. So it's like a bell-shaped curve. Most of the time, the returns are in the middle, that bell-shaped curve. We're looking at the two extremes. Probably your investment returns will be somewhere between very lowest and very highest. But we've got to remember that it would always be lower than the lowest or higher than the highest. We don't know. We don't know what the future holds. We haven't got a crystal ball. We just have to work on the basis of probability and think about your unique situation. What are you trying to achieve with your money? What are your priorities in life that you need your money for? How much risk can you tolerate? So can you tolerate those scary bits in the periods in the short term for longer returns? And also we need to think about something called your capacity for loss. And your capacity for loss is how much investment losses can you experience over a short period of time without having a catastrophic effect on your lifestyle. So someone who has a high level of guaranteed income from final salary, defined benefit pensions and a state pension, and it's enough to meet their expenditure, they've got a higher capacity for loss for their savings and investments than someone who might rely on those savings investments to meet their lifestyle and retirement. Or if you're still working and you've got a long period of time before you intend to retire, you've got a higher capacity for loss because you're putting money into the markets for your future retirement, so you can suffer those early losses, short-term losses, without damaging effect on your lifestyle. So I hope that's clear. I hope that's helpful. Let me leave you with the important disclaimers. But as I said at the start, if you've got any questions, please give me a shout. But I wanted to provide this with you now as a bit of a context so you're more informed in the investment decisions with your pensions, investments, or savings that you have. Thanks for taking the time to listen.